Welcome to Market Buzz. I'm Greg Schnell, the Canadian technician and host of the Market Buzz. Each show we do a deep dive into different industries using weekly charts to see what is happening on a long timeline. Please follow me on Twitter at Schnell Investor, and you can also find my blogs on gregschnell.com as well as stockcharts.com. So it's been a bit of a rocky start for everybody, and I think one of the biggest things we're all looking forward to here is trying to resolve the gap between either the stock market performance and the economy opening. It's been quite different. And as I heard somebody say on TV, so the stock market can behave as the Fed does, and the economy is totally different. And I couldn't help but chuckle as they mentioned that. So anyway, today bank charts are calling 911, and I wrote an article about that on StockCharts.com under the Canadian Technician on Monday, so you could see it. That article has some charts on it, and you can click on those charts and get the currently updated version. But the point I was trying to make in the article was that some of these bank stocks were anemically weak, and we really need to be cautious because when bank stocks start to break down significantly, that's a problem. And there are some stocks that are already breaking to new 52-week lows in the bank, so already past the bottom of the drop. So are we at the dashboard lights? Are we at the end of this rally? And I'm going to cover off some indexes, sectors, and industries today rather than go specifically into one industry. It'll be a little bit more of a wide view. The slope of hope is flattening, and what I mean by that is the momentum indicators have all kind of topped out and are going sideways, and so we either need the market to broaden out, which I thought we would probably get this week, and we did not. So that's a big concern for me. Anyway, that's kind of what we're staring at. My new website is open. Actually, that should say gregschnell.com now, new website. And I have a second chartered market technician on the site with me. Mr. Dwight Galusha is going to work with me. And we'll be putting out videos, newsletters, unique training courses on charting. And you can also find Dwight's latest work on the daily 5 charting. So go over and check out some of Dwight's work, but he's really exciting to work with. So you'll find some award-winning technical analysis on the website, weekly newsletter, weekly video, monthly recorded video conference call, and at least 5 trade setups a day. And now there's 2 CMTs working there, as I mentioned, so that's pretty good. And that just started, so we're excited about that. And if you're interested in the website, I did start up, now that the website renewal is all done, I did start up a promotion to try and promote it so you can save $360 using the coupon code DAILY5. So you'll need to go to the private investors tab and click on annual memberships if you're interested, and you'll see some of the work like what we're presenting today over on that site. So let's get into the charts. What I want to cover off here is the Nasdaq, and the picture that I show here is the Nasdaq going back to November, and you can see it was running up and running up and running up and running up. And what happened right in here was the Nasdaq was kind of pausing and then had a huge gap and went on this final surge for roughly 10 days. And then obviously fell down, and we ended up with this island gap. And what do we mean by an island? Well, you end up having an opening, so it gapped up in the morning, and here it gapped down in the morning, and so you have this opening that just sits there. So we had a 4-day gap where the whole chart is just frozen in time and sits up there. What happened on the Nasdaq is we've come all the way down, and now we've moved back up here, and what you see, we were kind of stalled in around this 8,900 level, and then we went on this sudden surge for a little more than 4 days. This time it was more like 6 days. And as we did that, we got up to the top here, and we're right back into this gap. And I don't profess to go back and review all the gaps on charts, but we got right up to this 94 level, which is kind of where we gapped down. So anybody who was buying above that is the only people who I'll say lost money on the way down, and then if they held everything all the way back in, they got almost to the top if they were in the Nasdaq 100. So that's amazing. in itself. But the point I want to make today, I'm just going to zoom out a little bit. So see, this uptrend here was a little more shallow than the one we're currently on. I will say the final gasp was pretty similar. Um, but what we see here is this big uptrend. And when we zoom in on this blue line, so I'm just going to take out a few of these months here, get down to one. What we see here is the close on Tuesday now had threatened the uptrend in general. I think it's very important that we understand how critical it is that the market holds up here, because we do have such bad underlying fundamentals. And I mean, we even have the White House warning us that things are going to get a lot uglier at the end of the second quarter. So, very blunt discussions by the White House, by the Fed. I know the Fed started its bond buying exercise today. We really need to be aware of the overall trend, and I don't think we're ready for this market to roll over hard yet. Still think we might try to bounce here. I think if we start to go below this black line, that's been support all the way through, and that was just a 20-day moving average, or roughly a 100-period moving average on a 1-hour chart. But the idea being, we're trying to hold above that, right? And as we're working our way higher in this market, we actually had a narrowing of breadth for a while, and now we had it pop out widely in the last 4 days, and that's really, yeah, I'll show you in my newsletter, but it's really frustrating that what it did over the last 4 or 5 days was kind of send all of these industry groups surging. And one of the things I didn't really notice was that we did that before. But I've got an interesting comparison for you to show you what happened here, specifically with the Nasdaq compared to the other two indexes. And these are the three trend lines of the indexes if you just put a line across the top of them. And the black line is the IWM, and the red line is the SPY, and the green line is the QQQ. So let's go add the QQQ just so you can see what that looks like. And when we post the chart on there, so we have this big uptrend, and I could have drawn it underneath whatever. The bottom line is we're still in an uptrend. We're still making higher highs and higher lows. Nothing has broken down there yet. I want to show you some other charts that might put that on pause. So anyway, we see how the green line matches up. Now I want to just silence the Nasdaq and put on the SPY and show you that. One of the big differences that you'll notice is this green line has kept going, and the S&P has really kind of lost momentum. Now, at the end of last week, this actually looked like it was finally going to break out and was grinding higher. Well, it just continued to get stalled there and has now rolled back over, and has a few days of work ahead of it if it's going to start to take out that high again. Now, that's the S&P 500. Now we also have the Russell, or the IWM, and now what I'll do here is I'll just turn that on, and if it's too messy with both of them, oh yeah, it's too messy. I'll just take the red one off. And the point of just showing you this is that one group of stocks in by itself, the Nasdaq, has gone on a run by itself, and I was having trouble with the fact that if the Fed was behind everything and going to push everything up, we should start to broaden out into the banks and into the industrials and into the industrial metals, because commodities all closed above their 10-week moving average on Friday, which was usually a pretty bullish sign. So it's still not over, but it definitely got a gut check on Tuesday with the final hour just plunging on the close. But the point I want to make is these last two markets are not following the Nasdaq higher, and so this is the first time where we don't have coordination between all the indexes, and it's basically since the end of April, since the Fed meeting, the Nasdaq has continued to soar, and the other two have gone sideways. That is a bigger deal, and if you just look at the Russell here, if we draw a trend line underneath it, we've now broken that trend line, much like the Nasdaq has. And I think that's one of the things that we're going to have to be aware of, is that these If all of these markets start to break their upsloping trend lines, that's probably a good place to be cautious. And I've got a few more ideas about things we might want to check on. I do want to point out what I did in my weekly newsletter because I think it's pretty important. So this is my Schnell Strength Index that I've created. What happens is as more and more industries start to push higher, we get the breadth to spread out. And we paused here for 3 or 4 weeks and then all of a sudden finally shot up this last week. And that was one of the real things I was hoping for, was to get more participation, some other groups starting to break out, particularly the materials and the banks is what I was planning on. So inside the newsletter, and this is what clients get each week. So what I had mentioned was down here at the bottom, I said as the breadth improves, we could still see the indexes stall, but big rotations to value from growth may start to show up underneath. So I would like to see, so even if the Nasdaq started to wane, perhaps small caps could keep going, or the banks would start to kick in. And areas I would like were the refiners, industrial metals, industrials. And it looks like the banks are ready to move higher. Should they start making lower lows, that would add to my frustration. But they are currently set up for big thrusts higher out of squeezes. And that's exactly what they did. They started to make lower lows. And as I said, that would add to my frustration. And that is a real problem. So the bears were seeing the resistance above the 200 or at the 200-day moving average, which was just above on the S&P, and the former highs. And the bulls were looking at the VIX had been dropping, better breadth and cyclical industry starting to improve. So I try to cover this off every week and try to make sure people are understanding how I get my opinions on the market and some of the things I look at. But the bigger thing that I was trying to explain here was all of a sudden we had a surge in a whole bunch more breadth, a bunch more industries starting to spin out. And I saw Dave Keller had posted an article on StockCharts. And one of the things he mentioned in that article was that, the breadth was actually improving right here. So it's interesting to see it pull down so hard on the close. When we go look at the advanced decline line, one of the things that I like to focus on the advanced decline line, not so much the day-to-day, but I really do like to focus on the big long-term trends. And what I've done is I've taken a line and drawn it across the bottom of these three, I'll call it pullbacks. And this is for the advanced decline percent. And in this case, I'm looking at the mid caps. But one of the things that happens is early in a rally, you get a big thrust, and then it starts to level off. Well, in this case, if we took that kind of leveling off action, it would pretty much parallel this big picture. And this line looks pretty much parallel. So we're okay in terms of style or steepness of the slope. If we were going to get this big rapid advance, which I was hoping we would get coming off the lows, we didn't really get it on the advanced decline line. Price moved up as quick as it did before, but the advanced decline line was much more muted. So, and again, just if people don't understand, what is the advanced decline line? We take the number of stocks advancing, let's say 2,000, minus the number of stocks falling. So we have 1,100 falling. We're left with 900. In order to create this cumulative line, we add it to the previous day, and we keep adding it and adding it and adding it. So during an uptrend, you're going to keep getting this big slope. And then one of the things that starts to happen is when the downtrend starts, all of a sudden, you're getting day after day where there's a lot more decliners. And even on Monday, we had a relatively flat day, but we had a lot more decliners than advancers. And so it's that kind of clue that starts to show up that even though the indexes are holding up, there's a lot of stocks declining underneath. So if I told you that already after 2 days of trading this week, we have well over 1,000 stocks that are down by 5%, and we have almost 400 stocks that are down over 10% already in the first 2 days of this week. That sounds pretty dramatic. It's that kind of subtle change that we see under the surface. So one of the things we like to keep track of is when the market is trending higher, that's important. And as long as the advanced decline line keeps holding its lows and continues to make higher highs, that's pretty bullish. What happened today on the mid caps is the mid caps have broken this uptrend, but they have not broken the advanced decline line. And so one of the things we'll be watching for as the week finishes out is, do they continue to break down? And if so, that would be confirmation to me that the market is now done its upward rally, and now we want to watch for the correction. So when we see that kind of change, that's pretty pivotal. Now, again, this is the mid caps. If we go up to the large caps, one of the things that happened on the large cap, so this is actually the S&P 1500. So this is the S&P 500, the mid cap 600, then the small cap 400. What's happened here is clearly the uptrend that we had going, which was relatively steep, is broken, but we have, I'll call it a more horizontal or a lower slope climbing out of here. Now on the S&P, this is obviously flattened out. On the Nasdaq, we kept going. What we see on the advanced decline line is this is already breaking down. So while the mid caps haven't broken down in their advanced decline, the large caps have. And this is quite an interesting twist because I just showed you the mid caps are holding up. And now for the large caps to start breaking down on their they'd have to be pulling back in order for this line to drop. Now I'll show you the small caps here as well. So just to get kind of a wider group, and again, these are the 1,500 biggest companies, so they're probably the bulk of the story. We still don't have a break in the small caps, but we, again, so the 1,500 had broken, so that tells me the S&P is getting weaker, and the 600, the mid-cap 600 is breaking down. Sorry, the small caps, mid cap is 400 and the small cap is 600. So here is the mid cap 400 and the small cap was the 600. So the mid cap has broken its uptrend in price and has not broken this uptrend. It wouldn't take much to do that. Now if we go to the small cap, it has broken its uptrend in price, and this line's a little bit looser because there's one point here and one point here, and I just took kind of a best fit between them to draw this line. Ran it as low as I could off the bottom of this one, so I wasn't being too biased. But in general, that's what you're trying to figure out. Is this trend breaking? I would say yes. And then we haven't broken through on the advanced decline. So if all of a sudden all of these charts, the 1500, the small cap 600, and the mid cap 400 all start to break down at the same time, I want to be aware of that because that to me is an important trend change. And if that trend was changing, then that would tell me we're probably going to have more pressure at the index level. One of Jim Cramer's favorite expressions was always, there's always a bull market somewhere, and I promise to help you find it. And in the 2008 downfall, it was kind of, 6 months into it or 8 months into it. And he said, I can't do this anymore. I can't keep trying to find stocks going up in a downtrend. And the next day, literally get hammered by it. And I think one of the examples that happened was BlackBerry at the time was the stock was doing very, very well. And it was running up and running up and running up. And on July 30th, Jim said, the BlackBerry still outperforming the iPhone. Apple stock is way down. BlackBerry stock is way up. And, so just follow the leaders, stay with the leaders. Well, it literally marked the top in BlackBerry, and I'll pick a number, $165. And it was like 6 months later, and it was at $60 and never really recovered after that. So it is dangerous to chase big names into an uptrend, and when it finally rolls over, and again, that was in July of 2008, the actual start of the correction happened in October of 2009, and then we worked our way down in March, up in May, and then down. And as the market was continuing on, some of these stocks were still outperforming, and again, okay to hang around in the name, it's really helpful. But what we need to remember is that the reason the indexes go down isn't because we want the indexes to go down. They actually reflect the action of the majority of the stocks within that group. So if you're going to be in large cap stocks and the overall average of the large cap stocks is dropping, it's hard to outperform. Roughly 80% of the stocks will follow the average on any given day. So as the market rolls forward, what you want to watch for is this is this change. And so the Nasdaq currently has been running, and the rest of the market has been going sideways. And the Nasdaq it has more biotechs. It has obviously the large cap tech names, that kind of thing. With that market structure, those names can continue to hold up. And I know, there's somebody had just put out a list the other day called their COVID-19 list. And with that, I think it might have been Jim Cramer. And I think with that list, he's saying these are the strong stocks that'll hold up in here. And the only thing I would like to caution you on is try to think more broadly about the backdrop. And when you're going to hold these stocks, think about will they be an island unto themselves and everybody is in there? And one of the benefits the US market has is they have the predominant volume of tech stocks around the world. And so everybody around the world who's investing, if they want to invest in tech, they have to invest in American tech. And so that gives them a lot of buoyancy. It really does. And then all of a sudden, when that whoosh comes out of it, all of a sudden people decide, hey, I got to exit here. Then all of a sudden that's a global pullback, and that could be enough to damage the strength of those big names. So I don't want to scare anybody out of them. I want to illustrate the point that these markets look like they're ready to break down, and Apple and Microsoft and everybody else went down 35%. I realize they all recovered and got back to near their highs. Just I owned Apple in '07, and and I bought it right at the top, and 8 weeks later I was down 20 or 25%. Well, Apple had brought out the iPhone and they were making more money every quarter, and the stock kept falling, and I couldn't figure it out. So much like we can't figure out how the stocks are holding up as the economy goes south, what happened back in 2008 was the stocks went south and Apple was still holding up in terms of performance. So really an odd dichotomy, but I think that's the difficulty here. If it was easy, everybody would get it right and we'd all retire on a beach. It's not quite that simple. So so when you're looking at your overall portfolio, the big thing to try and keep in mind, I've shown it a couple of shows ago, 2 or 3 shows ago, about how things looked in '07. And it's very easy to do. As a matter of fact, we could do it right now. But the big thing that I was going to try and point out was what groups were breaking down on Tuesday. And as they broke down, so this is an intraday from Tuesday, and I'm recording this Tuesday night. As they broke down, look at what broke down. So it was real estate, hotels, lodging, heavy construction. So that wasn't one of the things I was hoping to see. The aluminum index, the coal index. So all of a sudden, some of these commodities started to roll over pretty hard. And I mean, they went down 5%. So it wasn't like they were just taking a day off. They were down double what the overall index was dropping. And here's industrial metals falling very hard as well. So all of the things that I thought if they were going to break out, this was the week for them to do that. And instead, from their kind of squeeze down, they've actually broken down, not up. And so that's a big problem. Now, when you look through this list, again, industrial engineering, this is a lot of big business stuff as opposed to consumer stuff. Does that make sense? So all of these names are really starting to hurt. I guess apparel's in here, but the point I wanted to make was I wanted to see the construction and engineering and people start to reinvest in the market. Hey, the Fed's got our back here. We're going to be fine. And that's not what I'm seeing. And again, the bank index was down almost 4% here. Pretty brutal. So if we go to the other end of the scale and say what held up well, it was food producers, it was all of the safe stuff. This one's amazing. The automobile index held up very well. But when you look through here, it's utilities, it's consumer staples, all that kind of stuff. Gold mining index did okay. Multi-utilities, pipelines, they didn't drop nearly as much, and I think that's because they have more regular cash flow. But the big thing that we need to be aware of is that while these groups could still hold up, they're not the growth engines of the economy. So if everybody's going to go huddle into this group so that they don't drop very far, that would be a big surprise to me because they don't have a lot of growth attached to them. And when I go look through my charts, almost every one of them had a 30 to 35% pullback, which was quite healthy, or quite meaty, not healthy, quite meaty. There was a lot of movement there. So when we get back and look at this VIX, or this Nasdaq 100 chart, I just want to go grab, I think it might be up here. I want to go grab some charts from a different chart list, and I'll just show you again. The point I was trying to make was that the S&P 500 all the way through 2007, here you go. So here's the 1987. And this is the 200-day moving average. And what you were trying to do is get back above it. And so as we came out of the lows in October, rallied up. Well, we've already rallied right up to here. We're right up against the bottom. So the real question is, if we could start to surge through that, that would be pretty bullish. And maybe with $10 trillion, you can do that. Now, here is the 2000 to 2003 period. And you can see the stock market actually, let's just widen this out a little bit. I'm going to put 1999 in here. And the reason I want to point this out specifically is that we ran up and it was support, then it was resistance all the way down, and then it became support. So we're sitting right here. We're literally, we've had a big pullback, we're bouncing up against the bottom of it, and of course we don't have the right side of the chart. Does it do like it did back here and go all the way back up and we take out the prior highs and this is just a big bullish rally, or do we actually roll down? And so this is a major inflection point. It's not a point to be taken lightly. We've broken down significantly. We've broken all former uptrends, and now we're coming back to test this 200-day moving average. So that was 2000, and then 2001, down, then we had the 9/11 event, then we rallied all the way back up, failed at the 200, pulled back, and started to look like we were going to finally get above here, stayed up there for, what could be almost a month, 3 weeks, just hovered there trying to hold up, and then lost it all again and made lower lows again. So this is a really important place on the chart from a historical perspective. Now, lastly, let's quickly look at 07. Because we see the same picture. Basically, we came out of 07, we got stuck under the 200-day moving average, came down, rallied all the way back up into it, fell, and never got above it till all the way down into 2009. Taking it one step further, here's where we're currently at. We've got the big uptrend. Now here we broke down. We got all the way back through. We tried to take out the prior high, came down and found support again. Well, here we haven't gotten through, and we've spent about 3 or 4 weeks here trying to get through on the S&P. And the Nasdaq has made it through, but now this is sloping down and we're right at that critical point. So try not to understate the importance of where we're at relative to the backdrop of the macro economy. And if the whole thing is going to break down, we're at that inflection point. That's the critical place that you want to be aware of. So try not to get caught up in always trying to find the bull somewhere and then get taken out to the woodshed like the BlackBerry chart in 08. Try and make sure that you understand the critical inflection point, and if your charts start to break down, it's a good time to actually think about letting somebody take them over. Now, I will say one more thing. I saw this on Twitter, so I haven't checked the accuracy, but the recession caused by the 1918 Spanish flu was the shortest recession on record. So that's the good news. So thanks for taking the time to join me on Market Buzz. Market Buzz airs Wednesday at 10:30 a.m. Eastern. You can also see the recordings on StockCharts TV YouTube page. And don't forget to go check out the new website. If you'd like that promotion, you can check this out on the YouTube video. But Dwight's Daily 5 charts are pretty nice setups, and I think you'll enjoy seeing those. So thanks, everybody. Bye-bye.
Hey guys, Grayson Rose here with StockCharts.com. Thank you so much for watching. I hope you enjoyed this video. Remember, if you did, give us a like down below. Leave us a comment. We'd love to hear from you. And most importantly, don't forget to subscribe to our YouTube channel for daily content from an incredible collection of technical analysts and financial minds. We'll see you back here very soon. Happy charting, my friends.